Good morning and welcome to the Morning Bell. I'm Robert, joined by Lizzie and Steve. It's Wednesday, June 17th, 2026, and markets are holding steady as all eyes turn to the Federal Reserve. Lizzie, what are the main themes you're seeing in today's news?
Thanks, Robert. The dominant theme is really about waiting for Fed Chair Kevin Warsh's first meeting decision, which has created this interesting split in market positioning. We're seeing the dollar on edge, US futures steady, and this broader question of whether Warsh will take a hawkish stance given the inflation backdrop. But beyond the Fed, there's a notable shift happening in energy markets that's worth unpacking. The IEA is warning that a Middle East peace deal could actually trigger an oil glut next year, which is a complete reversal from the supply concerns we've been dealing with. At the same time, we're seeing real corporate impacts from the Iran war situation, with BMW issuing a profit warning, partly tied to these geopolitical tensions. What's interesting is the divergence here. Some veteran traders are actually making bullish bets on energy stocks, even as crude prices tumble, which suggests there's a disconnect between short-term price action and longer-term positioning. On the institutional side, we're seeing significant movement in the crypto space, with Coinbase getting reaffirmed at overweight by Cantor Fitzgerald, and Mark Cuban showing increased interest in the platform. Tech stocks are positioned for a rebound ahead of the Fed meeting, and there's this fascinating development where AI firms, including OpenAI, Anthropic, and Google, are being featured at the G7 summit alongside world leaders, which really underscores how central AI has become to economic policy discussions.
That's quite a mix of developments. The energy market shift seems particularly significant. What does this mean for traders looking at the week ahead?
The key for traders is recognizing we're in a transition period where multiple narratives are competing for dominance. The Fed decision today is the binary event that will determine short-term direction across asset classes. If Warsh comes out hawkish, we should expect risk-off positioning with pressure on growth stocks and crypto, potentially supporting the dollar and creating headwinds for commodities. But if there's any dovish signaling or acknowledgement that inflation is moderating, we could see a relief rally in tech and risk assets. The energy sector trade is more nuanced. The oil glut warning from the IEA is a medium-term structural concern, but the bullish bets we're seeing from experienced traders suggest they're looking past the headline crude price weakness and focusing on specific companies with strong fundamentals or those positioned to benefit from the energy transition. For the crypto-exposed names like Coinbase, the institutional validation we're seeing is important because it suggests the regulatory environment may be stabilizing, which has been a major overhang the G7. Featuring AI companies is significant because it signals government recognition of these firms as strategic assets, which could translate to more favorable policy frameworks. From a risk management perspective, traders should be keeping position sizes conservative until we get clarity from the Fed, but also building watch lists for opportunities that emerge post-announcement.
Let's talk about the major indices. How are you reading the technical setup going into this Fed decision?
Looking at the S&P 500, we're seeing consolidation near recent highs, with the index holding above the 5,400 level, which is providing decent support. The technical picture shows we've been building a base over the past several sessions, and the fact that we haven't seen significant selling pressure despite Fed uncertainty is actually constructive. There's a clear resistance zone around 5,480 to 5,500 that we'll need to break through with conviction to signal the next leg higher. Volume has been below average, which is typical ahead of major Fed decisions, so we'll want to see that pick up on any breakout attempt. For the Nasdaq, the story is similar, but with a bit more volatility given the tech concentration. We're hovering around 19,200 with support at 19,000 being crucial. The Nasdaq has shown relative strength compared to the broader market, which makes sense given the AI narrative and the positioning we're seeing in mega-cap tech. The key level to watch on the upside is 19,500. A clean break above that with volume would target 20,000 fairly quickly. The Dow Jones is actually the weakest of the three indices from a relative strength perspective, trading around 39,800, with resistance at 40,000 proving stubborn. The Dow's composition with more industrials and financials makes it more sensitive to economic growth concerns and interest rate policy, so it's not surprising to see it lagging. Support comes in at 39,400, and a break below that would be concerning for the broader market. Overall, the technical setup across all three indices suggests we're coiled for a move, but direction will be entirely dependent on the Fed's tone and guidance.
That coiled setup makes sense given the uncertainty. What sectors or specific opportunities are on your radar right now?
Energy is definitely on the radar despite the conflicting signals. The fact that we're seeing smart money make bullish bets, even as crude falls, suggests there may be value emerging in quality energy names, particularly those with strong balance sheets and dividend yields. I'd be looking at integrated majors rather than pure exploration and production companies, given the supply uncertainty. The financial sector is interesting heading into the Fed decision because if we get a hawkish hold, that could actually benefit banks through steeper yield curves and sustained net interest margins. Tech remains the battleground sector. The AI narrative is clearly still intact with the G7 involvement, but valuations are stretched in many names, so selectivity is crucial. I'm watching companies that have demonstrated actual AI revenue generation rather than just AI promises. The crypto adjacent stocks like Coinbase are worth monitoring because if we see any dovish Fed signals, those could rally sharply given how beaten down they've been. On the defensive side, consumer staples and utilities might offer some shelter if the Fed disappoints. But I wouldn't be overweight there unless we see a clear risk-off signal. One interesting development is CrowdStrike announcing a 4-for-1 stock split coming July 2nd, which often generates retail interest and momentum. Though the fundamental picture is what really matters, the key is maintaining flexibility and being ready to act once the Fed provides direction, rather than trying to front-run a decision that could go either way.
Now let's turn to crypto markets, Lizzie. What are you seeing in terms of trends for Bitcoin, Ethereum, and Solana heading into next week?
The crypto market is in a really interesting position right now, caught between improving fundamentals and significant macro headwinds. Bitcoin is trading in this critical range between $64,000 and $67,000, and that brief spike to $67,000 on the US-Iran peace deal news is being viewed skeptically as a potential bull trap. The sentiment is neutral with a bearish near-term bias because the FOMC meeting today is really the defining event. We're looking at a binary outcome. If Warsh goes hawkish, Bitcoin likely tests the 60,000 to 62,000 support zone, but if we get any dovish signals, we could see a move towards 70,000 or higher. What's encouraging from a fundamental perspective is that long-term holders absorbed 125,000 Bitcoin in June, which is a structurally bullish signal showing conviction buyers are accumulating during weakness. The $60,000 to $70,000 range is establishing itself as a macro support zone, with meaningful floors being built. However, there's a significant risk from a potential Bank of Japan rate hike, which would strengthen the yen and trigger unwinding of carry trades, creating a global liquidity event that would pressure all risk assets, including Bitcoin. On the institutional side, we're seeing mixed signals strategy. Formerly MicroStrategy continues buying Bitcoin, but its stock fell to $91, suggesting some investor fatigue with the leveraged Bitcoin proxy model. Meanwhile, BlackRock is innovating with new Bitcoin income products that offer cash flow alongside Bitcoin exposure, which is broadening the institutional investor base. SpaceX's transparent holdings of 18,712 Bitcoin add credibility to the corporate treasury adoption narrative. For Ethereum, the picture is more constructive. We're seeing whale accumulation at the $2,000 level, and the big catalyst is the Glamsterdam upgrade, which represents Ethereum's biggest protocol overhaul in years and is now in its final development stage. This Layer 1 scaling focus addresses Ethereum's core competitiveness issues, and historically, major network upgrades create positive price momentum as they approach deployment. Ethereum holding $2,000 with whale support and Uniswap surging 22% suggests renewed interest in the Ethereum DeFi ecosystem. The sentiment is cautiously bullish with a target range of $2,200 to $2,400 over the next week or two, assuming Bitcoin doesn't break down. Solana delivered an impressive 20% move, but is now stalling at key resistance around $78. The price action remains constructive, but there's some complexity with Treasury firm governance tensions as Solana Treasury companies are resisting consolidation efforts from forward industries. Still, Solana's outperformance relative to Bitcoin and Ethereum is notable. The key for Solana is whether it can break through that $78 resistance with volume confirmation, which would be strongly bullish and could target the mid-80s. If it fails to break through, we might see a 10 to 15% pullback as short-term traders take profits. Overall, institutional positioning in crypto is evolving. We're seeing more sophisticated products like BlackRock's Bitcoin Income Fund that essentially sells volatility back to investors, which appeals to a different type of institutional buyer. Retail interest is also shifting, with passive investors who initially avoided Bitcoin now finding themselves with exposure to volatile assets like SpaceX shares through various funds. The key risk factors across all three cryptocurrencies are the Fed decision today, potential Japan rate hikes, and Bitcoin's ability to hold that critical $64,000 support level. For traders, the best approach is probably to avoid large directional bets until after the FOMC decision and consider strategies that profit from volatility regardless of direction. For longer-term investors doing dollar cost averaging, the 60,000 to 65,000 zone for Bitcoin and the 2,000 to 2,100 zone for Ethereum represent historically validated accumulation areas based on on-chain data and whale behavior.
That's a comprehensive look at where crypto stands heading into this crucial Fed decision. Well, that wraps up today's Morning Bell. The key takeaway is that we're in a holding pattern ahead of Fed Chair Warsh's first meeting, with markets positioned for potential volatility in either direction. The energy markets shift, crypto's technical setup, and the major indices coiling for a move all point to the importance of today's Fed decision in determining near-term market direction. Remember, do your own research and consult with financial advisors before making investment decisions. If you found today's discussion valuable, please subscribe to the Morning Bell and join us tomorrow as we break down the market's reaction to the Fed. I'm Robert, thanks for listening.